Okay, guys, welcome back. So today we're going to talk about a subject that both of us have an interest in. You have, I guess, a personal interest in as well, given your heritage. You born in South Africa?
Born in South Africa, yeah. Family's born and raised. I was born.
So as you can probably guess, we're going to talk about South Africa.
Yeah.
We've also got a business there and a team there, and I've spent a bit of time there and really do enjoy spending time there. But there's also quite a large expat. So there is also a large expat community here in the UAE for South Africans. So I guess what we thought with this one specifically, we got a kind of more specific kind of case study, obviously anonymized and changed around. But in terms of this sort of subject of somebody that's lived here, worked here, mass affluent, earned money, got a big chunk of cash sat around. Lots of different other things going on, and looking to move back and retire in South Africa. So we thought we'd kind of touch on, because there's definitely some misconceptions that people see, that people hear, even from professionals. Sometimes there's misconceptions on what is, of allowed and
absolutely. I think, when anyone's repatriating, expatriation, changing jurisdiction, there's always going to be a lot of pitfalls, a lot of changes, and a lot of unknowns that you need to navigate. And it's important to seek advice and make sure that you are preparing and structuring ahead of that.
Yeah.
As Joe said, we do a lot of repatriation and expatriation services for our clients, both pre and post those moves, to make sure that everything is properly implemented. And we'll focus on returning South African tax residents for the purposes of this episode, but we'll turn it into a
and again, if people have some specific jurisdictions they want, drop in the comments.
Yeah, that'd be great.
We can prepare a video for that as well. So so maybe why don't you just set the background of this client? Obviously, like I said,
absolutely. So I think let's make this as useful for the audience as possible. So let's bring it down from ultra high net worth maybe to, let's say, mass affluent, which is probably a category the majority of expats who have been in the region, business owners, workers, whatever it may be, fall into, which is they've been here a while, they've saved good money, they've probably had a gratuity payment if they're leaving their job and going back home. And it's about how do they optimize and structure that. So for the purposes of this case study and the client that we've just onboarded and we're doing business with, this individual is actually going back to retire in South Africa, which again, I think is a very familiar story for a lot of South Africans, because obviously it's a beautiful country and it's a lot cheaper to retire. So, but yeah, let's keep it fairly simple. So saved a lot of good money, held in his personal name, just had a fairly chunky gratuity payment, and maybe some properties and bits elsewhere, but it's more those portable bankable assets that anyone who's retiring is going to be looking to really structure an income from, which we'll focus on. So, Joe, you're the tax expert. The first question is, upon relocating to South Africa or any other jurisdiction, if you've been in the Middle East and you've accumulated great assets, is there a tax on repatriation of those funds, or how does that work? Educate our viewers.
Yeah, so I guess in most cases, obviously you've got to caveat all these things with, I'm not an expert in every single country.
We'll put a disclaimer at the bottom of the description.
Jurisdiction, but in a lot of cases, there's no specific entry tax, if you want to call it that. And we've talked on one of the other episodes about the UK government talking about people coming back should pay tax on there is no entry tax per se. There are some rules in some jurisdictions where depending on the time you've been out, but no, in principle there's no entry tax, and with South Africa there is no entry tax back into the country.
So that's not a concern. If you've got $1 million sitting in an account and you're retiring back to South Africa or elsewhere, a concern is not that you're going to have to pay a tax on that $1 million. What does become a concern is what is happening to that money after you have landed back in that taxable jurisdiction, which is capital gains needs to be considered.
Yep.
Income arising from those assets needs to be considered. Those two first and foremost, and then moving on, obviously inheritance tax and other tax treatment on both assets in the country and international assets, and some jurisdictions do create that distinction.
Yeah, for sure. And I think that's, we also get very complacent, is probably the right word, here in the UAE, because there is no personal tax, there is no capital gains tax. So, everything we kind of make in terms of personal income is ours. So I think when you've been here for a long time, you sometimes maybe, get used to that. And so it is very much like you need to have that in your mind, that when you go back, those assets then become the income generated from those assets then becomes taxable, or like you say, from a capital gains tax perspective, if there's increasing value. So I think that's something that's really, really important. There's no entry tax, but there is tax on those assets, increasing value,
moving
income
forwards.
generation, etc. moving forward, like you said. Yeah.
Absolutely. So these were the taxes that we focused on, those three. So income, capital gains, and inheritance, which is what anyone who's really retiring needs to focus on.
Yeah.
From a South African perspective, there is capital gains tax. There is tax on income arising from assets. And if you're retiring, realistically, you are going to be structuring at least a portion, if not the majority, of your bankable assets to create an income for you to live off. And then obviously down the line, inheritance needs to be considered.
So a lot of people then would immediately probably look at a trust, right?
Yes.
That's what a lot of people would turn to is you stick your assets in a trust, you can earn income from them in a more tax efficient way. They grow potentially free of CGT, and then they give you a benefit of inheritance tax in the future. Sounds why that's a bad idea.
Yeah, exactly. So a trust is naturally where a lot of people go to shield their assets, right? England, South Africa, wherever it is, it's how do it has this connotation of hiding your assets from your personal tax liability.
Yeah.
We know very, very well that is not the case, and it's not as simple as that. Unfortunately, it'd be nice if it was. And South Africa's no different, right? South Africa's no different at all. So on the trust, I just want to create the distinction that there's a difference between putting your assets in a trust, which is essentially just having a piece of paper and that being the end of it, which is the incorrect way to do things, regardless of which jurisdiction you're in. If you control those assets on an ongoing basis, any tax authority internationally will see exactly what you've done. Oh, you're not so clever. You've just moved the assets over here, but we can see that you control it and it's in your estate, right? And tax you as if those assets were in your estate regardless, and probably apply a hefty penalty or fine on top of that as well. So if you're going to move assets into a trust, there needs to be a clear separation of control of those assets, not ownership, because that's what a trust fundamentally is, but a separation of control of those assets, which if you're a fairly young individual, whether you're about to retire at the age of 60, you're still going to live for 25, 30 years, maybe longer, who knows? Or if you're younger than that, giving up control of your assets 9 times out of 10, if we're talking about the majority of your assets, 9 times out of 10 is not a sensible decision whatsoever.
Or not what they really want either.
No.
They don't always think about that because they don't understand it. But typically if you then break that down, people go, oh, I actually don't want that.
Yeah, you are giving your assets away in complete control to a third party, an independent third party of which you have no say. So not only is there a control issue with trust planning, in South Africa, trusts are actually taxed very punitively compared to if you held those assets in your own personal name. So what I mean when I say that is if you hold investments in your personal name, you're typically going to be charged from a capital gains perspective at 18% of the gain.
The gain, yeah.
Yes. Or if you are holding income generating assets, it'll be taxed as income at your marginal rate, which is up to 45% in South Africa. A trust essentially doubles the capital gains tax charge. So in South Africa, the way it works is they look at your income band. For a capital gain in personal name, 40% of the total gain is assessable for capital gains tax. So 40% at the maximum income tax band of 45% equals 18%. For a trust, it's an 80% assessable charge, which means the maximum tax goes from 18% to 36% on gains.
Wow.
On income, it's taxed the same as your marginal tax rate, which would be up to 45%. But essentially, by moving that money into the trust, not only have you given up control, 2, you have doubled the tax that you're going to be paying on those assets while they're growing, investor generating and income generating gains, which would be 25, 30 years longer.
So the main question then is, why would anyone suggest that?
Well, it's heavily detrimental. The reason that someone would suggest it is purely from an inheritance tax perspective, because there is a benefit of moving the assets out of your estate. But South Africa does charge, as does the UK and most other jurisdictions nowadays, they do charge a disposal on assets from your personal name into the trust structure.
Okay, so then my next question then would be, well, okay, I'll do that while I'm in the UAE. So I'm in the UAE and now I dispose of my assets into the trust. But that also doesn't necessarily work because they can look straight through that as well.
Correct.
Right?
Exactly. SARS would look straight through that. The way that you can get around this is if you loan those assets into the trust, which essentially means this is not a disposal. I'm just gifting them to this third party legal entity or structure. But there's still a loan agreement between you and the trust. So you avoid the disposal tax of assets on the way in because it's not a disposal. It's just a loan of which the intention is obviously you will pay it back. But then this completely unravels the original idea and argument of setting up the trust in the first place, which, as we said, at least for this example, the only real benefit is inheritance tax planning, because that loan creates the connection between the assets and your estate. So upon death, when you die with a loan receivable, an asset that sits in your estate, guess what? You're going to be charged inheritance tax on the value of the outstanding loan.
Yeah. So the only way to, in inverted commas, avoid the entry charge, if you like, or the disposal charges is the loan. But actually the loan then negates the benefit.
Yes, exactly.
Which, kind of roundabout way is you're very much in this circular motion of like a problem. Okay. So,
and it's actually quite interesting because everything we've spoken about for the purposes of South Africa is actually the exact same for HMRC and the UK as well, right?
Yeah, or at least very similar anyway.
Yeah,
exactly.
So,
and then what's the solution? What's the answer?
What is the solution? Well, so a trust is a bad idea.
Yeah.
Don't get me wrong. A trust has benefits for the purposes of inheritance tax planning, and then you don't worry with the loan. The tax on the disposable assets is lower than the inheritance tax would otherwise be, and the same goes for the UK as well. So trusts are a viable wealth planning vehicle, but if you're relatively young, you're going to live for a long time, and you're not in a position to give up complete control over your own assets, it's certainly not a vehicle that needs to be rushed into for the purposes of retirement, income planning, tax planning, and inheritance as well. So the other option is, well, just keep the assets in your own name, right? I've already said the assets held in your own name are taxed at a maximum rate of 18% from a capital gains perspective, which is good news.
Yep.
Heavy discount compared to certainly the trust. But it's still not the most optimal solution. Now, the solution we've implemented for this South African client is actually an insurance-based solution in South Africa, more commonly known as an annuity, which is essentially just another name for an insurance-based investment account or investment vehicle, of which the tax is actually the same. So it's 18% on capital gains. The income is actually treated as gains for a reason I'll explain now. So instead of your income, i.e. your dividends, your coupons, whatever it may be arising from the underlying assets being taxed as income at your tax rate of 40, 45%, whatever it may be, that's also discounted down to the 18%. Mm-hmm. But the key distinction, the key benefit here is that the tax is only applicable upon withdrawal from that vehicle.
Okay. So year on year, there's no tax.
Exactly. Which is the jargon name for that in the industry is gross roll-up. Yeah. So gross, which is pre-tax, and then roll-up, which is compounding.
Yeah.
So pre-tax compounding rather than every time you buy or sell or a dividend or a coupon is paid from the asset, all of those events are shielded from tax, and the tax would only be applicable upon withdrawal, which may not sound massive, but it's actually remarkably powerful from a compound.
I was going to say that. Yeah. Because you're actually, effectively, you're reinvesting 100% of the money every year rather than reinvesting a percentage of that. Yeah.
82%.
Yeah.
Exactly. So PPLI for returning South Africans, PPLI is private placement life insurance, which is private assets, investments, stocks, bonds, cash, whatever it may be. An insurance wrapped investment account, otherwise known as PPLI, is actually the best, and 9 times out of 10 from the conversations we have and the planning we do for South African tax residents or future South African tax residents, absolutely the way to go from a tax mitigation perspective.
Yep.
You can obviously structure it to pay your income. You have complete ongoing control of your assets, so it removes that drawdown or massive
Downside.
Yeah, from the trust planning. And you can also list beneficiaries directly on the account as well. Furthermore, you can take an insurance-based policy and stick it in a trust.
Yep.
Remarkably easy, remarkably quickly, and remarkably cheaply, but just do it at the right time.
Yeah.
When it's more advantageous, when you have a clearer understanding and idea of, okay, this is what my life will look like between now and the day I die, which realistically is the last 5 or 10 years of your life, rather than the first and early years of retirement when you want to travel, you want more flexibility, you want to help your kids out, or whatever it might be.
Absolutely. And to be clear as well, in a PPLI, you can have pretty much any type of asset.
Absolutely.
Right? You can have property, you can have stocks and shares, you can have cash, but you can also have things like crypto.
Yes.
Which obviously I've got to get into every episode. But like for some people that is a part of their asset class now, and there are some things that are more like, and that's the other thing with the trust situation is that sometimes you've got to get effectively sign off by the trustees for everything. Like, they've also got to understand what the trust is investing into, and if say that is crypto, there's something that they don't understand, for example, then they might be less keen to sign off on that being as part of their trust. And I've seen that with a couple of cases where we've had to actually kind of really have a conversation with the trustees to really get them to understand and that's all very well if you say I want to invest in Bitcoin or Ethereum, but then if you say, well, I want to invest in this random coin over here, or this new project over here, they start to go, whoa, that's outside the risk tolerance. And
absolutely, or a new startup, a new business venture, whatever it might be. I've had conversations with clients who have put money into trusts where they've ended up having to sue the trustees to try and get their own money back.
Yeah.
And this is the problem: is realistically, everyone's got their own best interests at heart, right? So if the money is taking money out of the trust, well, the trustees don't want to lose that AUM, that asset.
No, they're getting paid off.
So they're going to jump up and down. They're going to delay. They're going to make you jump through hoops, and you're really fighting for control of your own money.
100%.
And that's in a scenario where you do still have an element of say and control over those assets, which not all of these things are black and white, but the more control you have from an ongoing perspective, the greater the chance of scrutiny and the tax authorities looking through and just completely disregarding the whole
thing. And that's the whole thing, right? Is you can't have a cake and eat it, as they say, right? You can't have a fully out of your possession trust and then dictate every decision. And that's the other thing I think is that if this particular trustee has no clients that invest in crypto as an example, and then all of a sudden they invest in crypto in yours, that's going to raise questions as to how much influence did you have over that, that decision. So I agree. I think there's a lot of benefits to PPLI in this case specifically.
Absolutely. And a lot of these structures, solutions, and options all have pros and cons. It is just an example like this where we assess those pros and cons that really highlights and stresses the importance of speaking to qualified professionals and advisors who know exactly what they are doing and understand the various options and pros and cons of each, rather than listening to someone who maybe isn't fully qualified and isn't doing this day in, day out.
Yeah, 100%. And also sometimes they're quite jurisdictional. Like, they understand the UK, they understand South Africa. They don't necessarily understand the global perspective either, right? So so again, as always, that's what we're here for. That's why we're bringing this content. So if you want any other jurisdictions, as I said at the start, please do comment in the video. And if you want to get in touch with us, you can visit our website. There's a link in the description, and there's a contact form on there for a private consultation.
Absolutely.